A major market crash is long overdue, and we look at the statistics and see that there are so many different reasons why this will occur. There is a crash ahead. Let's look at the fourth longest bull market in history, the one we're currently in. You came here for the truth, so let me unveil that for you. We talked about this before, and I know that you've read it also, and this is basically the Fed's Bullard basically saying that the markets misread him in October bond buying, and what he had said was that, look, we are going to need to print money if things start going sour. And now he's coming out and saying, look, you read me wrong, that's not what I said. And if you actually read the article, read his quotes, he says the exact same thing again. If the market runs into trouble, we're going to have to print money. And that's no different than anything that they've been saying, Ben Bernanke, all the way back in 2002, before he was chairman. In his speech that I have shown on this program here many times before, all the way back in 2002, he's saying the same thing. Then you have Janet Yellen saying the same thing. And now you have Fed's Bullard saying the same thing. If the market starts to tumble, they're going to print more. They have the interest rates low. Now, another thing that he did say in here is that they once again mentioned this time of approximately the spring of 2015. And when that happens, they're going to want to increase the interest rates. If they do, maybe it's going to go at, less than 1% for sure over, let's say, a year span. There's no way the market can take even a fraction of 1% of the increase. So this will be very interesting. It looks like the market is continuing to hit new highs all the time. They don't have to worry about money printing. They don't have to worry about interest rates. If everything is so good in the economy, why not start increasing the interest rates? But of course, everything is not fine. And I'll get into that in a moment here. Let's look at this chart. The bull markets and the Dow Jones duration in years. And you can see right now that we are in the fourth longest bull market in history. You may not be able to see it from the graph right here, but some of these take decades to regain their strength from, and you're looking at right now where they're just on a boom that has been going on, and there is nothing that's going to change that because everything in the economy is just fine. But let's come back to reality. This information is out of Bloomberg and RBC, and we have to really look at this and figure out what were the differences between the last bull markets and the differences between this one here, and we need to monitor this, because if things are out of whack, we're going to have big trouble for the future. So let's go into more details here. This is going to show you equity market bubbles and time to recover losses. We'll look historically back. That's what the Money GPS does. I talked about it a lot in my book. That's what I talk about here. I always relate it to the historical data because that's how we can figure what's going to happen in the future. Of course, things change, absolutely, but we need to use history to be able to predict the future. When there's too much debt, nations collapse. That's what happens. Nations default. They encounter hyperinflations. This has happened before. Nothing is new. But when you look at it, ever since that moment of the financial crisis began, it's as if all of the past history has been wiped off the map, wiped out of the history books. It's so sad the way they do this. So if you look at this point right here, I hope that you can see it, but essentially they're starting at the 100 points right here on the left-hand side, and then from there you have your crashes. So let's look at the S&P in 2007, and you can see that's the first one that begins to rise. It rose so dramatically, but then you compare that to the S&P in 1929, that's the dark blue line, and it takes decades to return to its previous highs. And that goes to show you how long it can take sometimes. But when you print up trillions of dollars and completely dislocate the economy, you're going to have things going up. And what is that? What happens with that? I talk about it all the time. You have rising prices. Sure, the stock market can go up if you print trillions upon trillions of dollars, and I'll show you in a moment how many trillions they printed. And you can have that happen, but the result of which is higher electricity prices, higher food prices, and so on. So let's go on to more details here. This is the S&P. I mean, I can't believe anyone, any mainstream economist can look at this chart and not be worried. Sure, they're saying, look at this, it's so strong. But the way I look at this as, you can take a ruler to this thing and draw how straight this thing is. It's like a computer algorithm drawing a straight line going upward, mountain climber, right up this thing. And this will not stop anytime soon, it looks like. But the fact remains is that interest rates are at 0%. If they found that the economy was strong, they would be able to increase the interest rates. Look at all around the world where you have developing nations. When their economy begins to overheat, what do? Every single time? They increase the interest rates to calm down the inflation, to sort of put a damper on how hot this market is, to prevent the hot money from flowing into the country. That was the big mistake they made in Asia in the 1990s, where we had so much money pumping into the system, and it ended up crashing a lot of these economies. I know that some of the subscribers here will be able to tell you more information on that. So let's go into what I wrote about in my book. And the first point I want to make, it says this: the government was able to keep the unemployment rate quite low between 1923 and 1929. So we're talking about the roaring 20s. Just like what's happening right now. Everything was booming. And it said, on average, it was only about 3%. So right now, we have approximately double of the unemployment rate that they had in these years of the roaring 20s. And they also had this: the total money supply, the total amount of money in circulation in the US increased over 60% during the 1920s. The monetary supply has increased. I don't even know the actual statistic. It is many fold over the previous, just before the financial crisis. And you look at the chart, I've shown it so many times, the hockey stick that is created at this point. As soon as they began printing the money, you're talking about trillions upon trillions of dollars that were printed. The monetary supply increased way more than this. So you have two factors right there, and that's what we need to talk about. The fact that the unemployment rate is significantly higher at the same time as you have the total money supply increase dramatically in these years. You have this, just in these two examples, you have two reasons why the economy is much worse than it was just prior to the Great Depression. This worries me. I hope that it worries you too as well. And let's get into this. Out of the Levy Institute, they calculated $29 trillion, a detailed look at the Fed's bailout of the financial system. They had to print up nearly $30 trillion of this garbage fiat currency in one country alone in order to prop this system up. If they did not do so, it would have crashed the system. So we look statistically out there, and all of the fools are misguided in this, but I know that you are right on track. You think about it, the balance sheet of the Federal Reserve is about $4.5 trillion. Where in the world did the $30 trillion go? And that's right, it remains off the books, off the balance sheet. So why not wipe out all $4.5 trillion? Why even have a balance sheet? Make things completely unavailable to the public. Why even show us these stats when you're gonna lie about every single thing? It's crazy that the way they do this. Now, if we get into the stock market a little more, I want to show you one thing here. I just wanted to include this as part of this video. It's talking about the stock buybacks. That's actually the reason the Financial Times is suggesting, and I definitely have to agree with it somewhat. The reason why the stock market is increasing right now is because companies are buying back a lot of their own shares. That's a lot of why these companies are actually increasing. And he also noted in here, if there was reason to invest in a company, if the growth was doing well, if the entire economy was doing well, you wouldn't need to have the stock buybacks as much as they are doing right now. We're looking at a situation where they are worried, where they're scared, so they're actually doing this right now in order to keep their own system propped up. A lot of this has happened historically, and you can see this throughout the previous bull markets. Now, I wanted to tell you guys just one thing here about the Money GPS. We're heading towards 10,000 subscribers. I want to thank each and every one of you, and I wanted to create a series of videos coming up in the near future at some point where I can do very simple videos, maybe about 5 minutes in length, and just get into the basics where I can say, what is a bond? What is a stock? How does the stock market work? Very simple things that you yourself may know, but your friends, your family, they may not. So we don't have to necessarily get into the details what they're doing behind the scenes, because oftentimes our friends and family aren't really interested. But perhaps some of these more simple videos, I can put them in the playlist, the Money GPS e-course, and then they can watch the playlist and they can have very simple things. If they want to learn about stocks and what is a stock and how does it work, we can get them interested in this information, and then perhaps that they will want more and they'll click on other videos and they'll find out the truth. So that's my intention with that. If you guys think this is a good idea, please give me a thumbs up on the video or comment below. Let me know. And of course, don't forget to become an insider. The Insiders is where I give out all my best intel for free, and that is available at themoneygps.com. You scroll down to the bottom, fill in your email address, and you get occasional emails from me with good, short, concise info.